Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker right here in Santa Clara County, helping folks buy, sell, and invest in real estate since 1988. And I realize it has been a very long time since we have seen each other. I think we're creeping up on 2 years since the last show. I appreciate you, for those of you who've been with me since 2007 when we started the show in January, actually, of 2007. Thanks for hanging out with me all these years, and thanks for the encouragement to kick the podcast back up again. I'll save the discussion about what kind of kept me out of doing the podcast for this long, maybe in a coffee and real estate live chat, maybe during the pre-show phase, which is where we have casual conversations before the live chat begins. In fact, we're going to have one of those coming up here in March. So it's on the third Saturday of every month. So feel free to join me there if you want to have a chat about that. But what I wanted to hit on today, and maybe it's no longer a headline grabber, but I think it's something worth talking about, and that is the idea of extended mortgages. So the most recent celebration of stupid financial ideas has been the 50-year mortgage. Not a new concept. If for those of you who have been listening to the podcast for a long time, you know that one of the last podcasts I did 3 years ago was about the 40-year mortgage. Everyone was floating the idea of the 40-year mortgage. And we talked about it then. I did a podcast about the 40-year mortgage. Pretty sure I did a podcast on it. I'm sure someone out there will correct me if I'm wrong. But I wanted to talk about the 50-year mortgage because it's a rehash of these ideas that to solve the problem is to trim around the edges of how people accumulate debt and what kind of debt they accumulate and how crazy that debt is. But I don't want to just talk in general. I want to make it relevant. So what we're going to do is we are going to discuss mortgages in general. I mean, because what we're going to talk about actually applies to mortgages of any length, right? We're going to talk about how it affects buyers, what buyers should be thinking, and what kind of self-assessment do they need to do to figure out whether or not these programs make sense for them. We'll talk about how it affects sellers. And then finally, we're going to talk about how it affects the community at large, because it does, whether we like it or not. In fact, mortgages we have today affect the community at large. So let's kick it right off and first talk about, let's talk about sellers first, since that's the easiest one. Sellers don't care. Escrow closes, you get paid, end of story. That's it. How that money gets put into escrow and how you get it and how you can spend it are completely up to you. So you don't need to worry about how the buyer came up with that money. The only thing you need to worry about is, can they come up with that money? So the only thing you need to do is to be assured of the credit worthiness of the buyer. And believe it or not, your real estate agent should be following up on this. This should not be a mystery to you. Your real estate professional should be having a conversation with two people. At least this is how I do business. When I'm evaluating an offer that comes in, it's not just what does the offer say. It's about who's making it. And that is an ignored fact far too often. So there's two things you need to do. One, you need to talk to the lender that's going to fund the loan, right? They should have a letter, a pre-approval letter, or, and there's different flavors of pre-approval letters, but let's not get into that field of weeds. See who that's from. What bank is it from? Who's the lender? Who's the actual human being they're talking to? Your agent should call that person and have a conversation with them about the credit worthiness of that buyer. Now, they're not going to share with you personal information, but I have found over the years that having a one-on-one conversation with that lender is profoundly helpful. You're going to get a vibe. If you're someone who's been in this business for longer than a couple of years and who's been doing this and having conversations with all these lenders, you're going to get a feeling for how confident you should be that this person can follow through on their contractual promise, right? Second, talk to another lender. Talk to a lender, or have your agent, your real estate professional. Talk to another agent they've worked with, a trusted partner. Now, I have one right here in Morgan Hill who I work with or I have chats with, and I would call him and I would say, listen, here's the deal. This is the loan. What are your thoughts on this loan? And usually I don't have to have that conversation with them a lot because I've had enough conversations with them that we've had that particular conversation before, and I can't really share personal information about the buyer with that person because that wouldn't be ethical. So I don't. But if it's a situation where I feel like there is gray areas in this loan that this buyer is suggesting for this purchase, I'm going to have conversations with a non-connected lender who's going to be honest with me about what's going on. And I know they'll be honest with me because they want to maintain their relationship with me. So if they steer me wrong or feed me a line of bull and I detect that, I'm never going to send them a buyer again, right? So these are things that a real estate agent who knows their business and been doing business for a while should be able to do for you as a seller as you're evaluating this offer. Should you be more concerned with longer terms that go beyond 30 years? I think so. Lenders are concerned. Lenders tend to do 40 and 50-year mortgages. So if they're concerned, you should be concerned more because the bank is concerned, right? What's the probability that at the 11th hour, a week before close of escrow, the lender is going to deny the loan and say, okay, we're not going to fund it. And odds are you're going to have a loan contingency in that offer from the buyer saying, hey, if the loan won't get funded by the bank, we get to get out of the deal without giving you any money. We don't give you any of our deposit. We get to take all of our money and leave. And so now you've had your property off the market for probably a month. You've lost all that time. You've lost all that momentum, and that's bad for you. So that's really it. But again, this is an intelligent conversation you should be able to have with your real estate professional, and hopefully you do. So if you haven't had that conversation yet and you are looking at offers on your home right now or about to start looking at offers, make sure you have this conversation with your real estate person to make sure they're doing this. It should be part of the service they offer. Okay, that takes care of sellers. Really, it's just about making sure that when escrow closes, you get a check or a transfer, a wire transfer that actually appears in your account, right? That's all you care about because probably the rest of your life depends on that money. Purchasing another home, the coordination of closing escrows of two different property. You don't want it complicated by a higher probability of inability of the lender to provide the funds the buyer needs. Okay, now let's talk about buyers. And this is probably one of the more complicated things to consider because as an instrument, what does the buyer care about? Just managing debt. So some questions to be asked. Do you know you're going to stay in this house forever? Is this your forever home? Are you going to move in and never move out? Are you just as likely to move within 4 to 5 years, right? The typical, 4 to 7 years. That's typical for folks who buy a house. Now, I'm one of those people who tends to buy and stay in it forever. I've been in the house I'm in right now for 23 years, 24 years, creeping up on a pretty long time. So that's a question you have to ask yourself because you need to make a purchase that suits your goals for that property. And that includes how much money you spend per month on the mortgage. So, but one thing you need to understand is the longer the term, the likelihood is that that's a higher risk loan, right? Because no one knows what's going to happen with inflation over the next X number of years. Nobody knows what's going to happen with the economy over 20 years, 30 years, 40 years, 50 years. So it's a higher risk. So there will be a higher interest rate. And when you start doing the math on figuring out how much you're going to pay for that $500,000 or that $1 million over the next 50 years, you're going to be spending more than double. Right? You're not going to ultimately have paid $550,000 or $1,100,000. You're going to have spent $1 million or $2 million on that loan, on borrowing that money, on renting that money. And the other thing you need to be honest with yourself about is this: how disciplined are you financially? So let's say you do get the very best monthly amount with that 50-year loan that mathematically makes sense. And you're right on the edge. Now, I would often suggest that for a buyer I'm representing that you really reconsider whether or not you want to purchase at that price point if it's that tight. I often suggest that my folks buy 10 to 20% less house than they can afford when they're purchasing a home because you want to have that elbow room. And that's with a fixed rate loan. So a variable rate loan is even more different, right? There's all kinds of things. I need to make sure my variable rate borrowers who are buying a home understand that in 5 years or 10 years or whatever it is, that this is going to readjust and your payment's going to jump. So I try to educate my buyers as much as I possibly can on the process as we go. But what it really comes down to is your level of discipline as a buyer. Let's say that we've taken care of all these other considerations and you're looking at this loan and you're saying, well, you know what? I prefer this lower amount. But right now I could afford to pay more. But I'd like to give myself a little elbow room in case something horrible happens. Like I get laid off and I need to go down to and I need to have my expenses cut as much as possible. So here's the discipline you would need to have. You would need to be able to say to yourself, all right, I'm going to get this loan. And let's say it's a $3,000 a month mortgage payment. I'm going to pay $4,000 a month. I'm going to make payments like it's a 30-year loan on this 50-year loan, just so that I have this card in my pocket that I can adjust that payment down if something terrible happens. And this is a self-realization you need to have right at the beginning, because the best time to pay down your principal on a mortgage is when it starts, right at the very beginning. The more you make payments as you go, you're spending a little bit more towards principal than interest. Now, when you start off, you're paying almost all interest, right? If you look at an amortization schedule of a loan, it might make your heart break a little bit when you realize how little you're paying down the principal. But if you pay down that principal up front, your later payments end up being more towards principal because you've paid off the amount that it's mathematically calculated on as you go, right? Does that make sense? So for instance, I on the house before this one, I got a kind of a weird loan, not horribly weird, but I had to be disciplined. I had to decide I'm going to spend $1,000 extra per month on this mortgage to achieve my goals. Now, that ended up being the smart thing to do. I wasn't 100% sure I was going to move in the timeline I thought I was going to move, but I knew the place was going to be too small eventually. Little did I know that less than 2 weeks after close of escrow, we would discover we were pregnant with twins and we needed to move far more quickly than I ever could have imagined. But in any event, we stayed in that house for a year or two, even after the twins were born, and just sort of tripled up in a room because I already had one young son at the time who was less than, I had 3 children in 2 years. So just, it's a long story and it was painful. And once you're outnumbered by your children, it's a whole different story, right? But anyway, so if you understand yourself enough to realize you are not a disciplined borrower, and that there's no way you're going to be disciplined enough to make that extra payment on the front end, then never do these kinds of things. You want to stick with at most a 30-year mortgage. The bottom line is you end up paying so much more for the money over such a long period of time that at a time in your life when you really want to achieve home ownership, if you're buying your forever home, that's 50 years. And the odds are you're going to be 20-something when you make that purchase, or even 30-something. That means you're 70 to 80 years old when you pay that thing off. So it can impact your entire life timeline and make it so it's impossible for you to even come close to thinking about retiring at 65, right? Where you have to be 70 to 80 years old before you own the home. And maybe for some of you, that's not even a goal. Maybe retiring with a home that's paid off isn't a goal. However, if you're someone who's also not disciplined and doing that $1,000 a month toward the mortgage, you also might be someone who's not disciplined enough to be putting enough money into that 401k in your early years to facilitate that retirement when you're older. So I'm going to suggest in that moment of self-reflection and embracing of reality, you decide if this is something you can do. And if you can't, don't do the 50-year mortgage or the 40-year mortgage. Go with a conventional 30-year mortgage. And even with a 30-year mortgage, I suggest you at some level try to pay a little bit above what is owed towards principal, whether it's just $100 a pop or $50 a pop. And it's extremely powerful to do that at the beginning. So let's say your monthly payment's $4,000 a month, do $4,100 a month with $100 going towards principal. Every dollar you spend there is going to save you tons of money way down the road. It's the magic of amortization. Next, let's talk about how it affects the community. And normally, you wouldn't have to have this conversation, but the reality is the 30-year mortgage wouldn't exist. Maybe a better way to put this in terms of not just community, but in terms of legislative impacts. Because we're not just talking about giving someone an option for 40 years or 50 years. We're talking about dramatically increasing the level of risk in a financial environment where taxpayers assume all the risk of the loans. If you can remember back 2007, 8, during the crash, we had all of these government-sponsored entities, GSEs, right? Fannie, Freddie, all these organizations that underwrote these loans. And that's what we're talking about. There's no way a 40-year or 50-year mortgage exists without federal backing. The reason is because the risk is too high. Banks wouldn't do it. It's not enough of a payoff. It's too long of a loan. So what will have to happen is it'll have to fall into the category of what is our 30-year loan, meaning the bank underwrites the loan to a checklist of requirements that the government provides to them. And if it meets all those requirements, it can then be sold on the secondary market to these government-sponsored entities, Fannie and Freddie and all that kind of wonderful stuff. And by doing that, the taxpayer assumes the risk for that loan instead of the banks. So the banks just wash their hands up. They're done. They've underwritten the loan. They've followed the rules provided by the federal folks. And then on the secondary market, they sell it. That's why for those of you who've bought a house, it is very common for your loan within a few months of your loan being funded, and you're paying maybe Wells Fargo or Bank of America or Chase or whoever it is, and suddenly it changes. That happens all the time. Now, depending on what kind of a credit risk you are, because they bundle these loans based on the credit worthiness of the borrowers, which is how you get subprime borrowers and things like that. Mine got sold, I think, by Chase or someone else to Wells Fargo. Well, at the point I did that on this property, I was a very low credit risk, and that's why it ended up going to simply another bank. You may find that your loan is now owned by Fannie or Freddie or some other government-sponsored entity. That means if you default, it's on the taxpayers. And actually, it's even a thing covered by other banks. I think it's a little bit more complicated, but let's try to keep it simple. All of us as taxpayers, assume a certain level of risk when the federal folks decide to embrace even higher risk lending instruments like a 40-year loan or a 50-year loan. So for sellers, don't care as long as you get the money, and that then your focus should simply be on verifying that is highly likely to happen. For buyers, it's personal finance. For all of us, for the country, it's how likely is this to bite us in the butt like 2007 did. And the bottom line is it increases the number because the folks who are going to get 40 and 50-year loans are not going to be folks with the greatest credit. That's just a reality. The vast majority are going to be from folks who already represent an elevated risk when it comes to lending. So we would be priming yet another pump full of subprime borrowers who could potentially default if the market takes a dip. And given what it would take, I mean, how long would it take for someone, because also remember that the assistance programs that go on where many buyers will make a purchase through a program that makes it so they only put 1% down or sometimes no down. There are programs where people can put 0% down. If you have no skin in the game and you've been paying into your mortgage for 5 years and you discover you've only paid down your mortgage by $5,000, $10,000, if you're lucky, $5,000, and then property values go down and you discover your home is worth $50,000 less than you owe on it, these are the kinds of realities that pushed our market in 2007 into a place where people simply abandoned their loans. So again, longer terms tend to be higher risk borrowers, higher cost loans because of the elevated risk, and it gets reflected in the interest rates you're paying. And then at the end of the loan, you've absolutely gotten hosed. You have paid more than double what you borrowed in terms of interest rates. So that's kind of it in a nutshell. Now, again, if you're a super disciplined buyer, regardless of what the community things are or the seller things are, if you can make it make sense for yourself and you can apply a certain amount of discipline into the process, maybe it works for you. But as as a plan for a long-term purchase where you're going to stay in it for a very long time, not something I would suggest. So overall, I think there are far more negatives than there are positives, and that in general, these are all very bad for individual buyers and for the housing community in general. Those of us, for the public, who would be on the hook for whatever amazing costs might get generated by folks defaulting on those loans. All it does is contribute to the higher probability of default. Okay. So that was a relatively quick one for the first one back, the first show of 2026. Now, I do plan on doing these on a regular basis, as I used to do for oh so many years. So feel free to join me. You can find me at soldbyrobert.com. I've got some great tools up there for sellers or homeowners who want to get great information on what their home is worth, plus a lot of other tools relating to assessing your mortgage, whether or not it makes sense to refinance, and showing you different options. So feel free to check that out. Again, soldbyrobert.com. All right, folks. Thanks again for spending your valuable time with me. I hope I have left you with more knowledge than time I've taken up, and I look forward to talking to you next time.